Hey, everybody. Welcome to the Steps to Soul podcast. Today, we're going to talk about due diligence, what to expect, and how to prepare. Before we dive in, Chris, it's Masters weekend. I'm thinking Rory's going to take it home this time and finally complete the Grand Slam. Who you got?
I've got to go with the defending champion, Scotty Scheffler here. Not really local, but regional favorite, being from Dallas, Texas. He's looked good this year, so I'm gonna be pulling for Scotty.
He's been doing good. And a hot take to anybody else out there: Colin Morikawa plus 2,000
Whew.
to win the first day leaderboard. Take it,
Yeah,
it. I'm on it.
Got it.
All right, so since I did my due diligence for my Masters bets, let's talk about due diligence in selling and buying a business because that's what we're here to talk about today.
Let's do
And first off, like I said, there's due diligence for buyers and due diligence for sellers. Both are going to use pretty similar documents, but how you go about doing it, when to do it, why, and how much, we're going to dive more into that. Specifically, we'll give through the process, when to do it, which steps, which documents, if you've got a lender involved, all those different factors. So if you're excited about selling the business, you're thinking about buying, stay with us. We're going to give you some great pointers on how to maximize your transaction and get it done correctly. So with further ado, what is due diligence, Chris?
Yeah,
In the general business sense, it's due
right.
diligence means vetting issues that affect the business thoroughly and carefully. Not to cut you off there, but
No, you're good.
that's kind of, is that it wrapped up in a nutshell? Just
You got it.
vetting the business.
Right, exactly. It's more than just reviewing documents, right? It's a risk assessment. Buyers want to know what they're really purchasing.
Well said.
Yeah. So they're going to dig in. It's going to be not only the financial health, it's going to be the legal standing, operational stability. It's so important for sellers to be prepared for that, right?
Yeah, absolutely. And I would even add to that employee diligence. There's diligence you can look on paper. You can look at accounts and bank statements, but there's also diligence of looking at the company culture, the structure, customer relationships, looking at Google reviews, looking at reports on Facebook and other apps, other social media where what are people saying about this company? Is there a trending in the right direction? Is it trending in the wrong direction? Has there been a recent problem? Like say there's 500 reviews. The first 400, all 5 stars. The last 100, up and down. What could have caused that? Well, was there a death at the company? One of the owners. That's explainable. Has there been a issue with product? Maybe right now tariffs, prices going up, people being unhappy. Or it's just a bunch of Karens getting mad online, which everybody deals with these days. But we're not going to worry about the Karens. We're going to focus more on what you got to do to be happy. So first off, due diligence has a lot of work you're going to have to do. There's a lot that you as a buyer or seller are going to have to be prepared to buy or sell the business. But you also need outside help often. Those outside parties could be an attorney for legal due diligence, a CPA for financial due diligence, and even for some people, a financial planner for what to do with the proceeds afterwards. And I think people think of the first two, a CPA and an attorney, but they don't think about the financial advisor. Chris, tell me a little bit more about your experience with those guys in transactions.
Yeah, they're going to get involved at some point, right? You're going to need that CPA to hand over the tax returns if you don't already have them or verify them. And especially the bank. I mentioned the SBA bank. They're almost going to do their own due diligence. They actually are. In fact, I met with a client yesterday. He didn't really even do the due diligence on a business he had bought 5 or 6 years ago. The SBA bank he was working with did all that. And, I strongly encourage a buyer to do your own. But yeah, it's always great to have bankers and CPAs and lawyers looking after you and making sure that they're doing all their checks and everything's checking out on their end.
Absolutely. And we tell people, a conventional loan takes a lot. An SBA loan is a step above. A conventional loan is like playing in AA. An SBA loan due diligence is like major league. You're going to be going through so many documents, but that's a good thing as a buyer. You should be happy for that. Yes, it's work. And yes, as a seller, it's going to feel maybe tiresome at times submitting all those documents. And we'll get to how you prepare for that later on in the podcast. But man, it's so important to let that bank help guide you too. Because man, they're going to check out things even sometimes we as brokers don't think about matter for that industry. And that's not that we don't know what we're doing, but man, there are some things that the bank factors in from past deal experience that brings value to the table, which is also so important.
Yeah. No, due diligence is ground zero for trust, right? In the deal. The buyers perform due diligence to verify that what was presented in the SIM that we put together is true and accurate, right? And so for the sellers, it lays the groundwork for the post-sale transition and success as well. especially when seller financing or an earnout is involved. It's just building that trust into the deal.
It is. And often we'll talk about, coming up soon in document review and other issues with that. But like any good business deal, trust is probably the most important issue. If the buyer doesn't trust what you're producing, there's a problem. And we'll discuss further how to prep that. But no deal gets done if you don't trust each other. Or if it does get done, it's so strained, transition is going to be so much harder. Because now you bought this business, you didn't trust the person you bought it from. What are you going to do with it?
Absolutely.
Like,
And especially if
whoops.
they're going to stick around for quite a while, they're going to be around for
Absolutely.
6 months, a year, and now you're working with this person and learning from them that you really don't fully trust. That's a rough start.
It is. I mean, it's like getting married to somebody you don't trust. How well is that marriage going to last?
Not very
Let's
long.
be honest.
Yeah.
No, I wouldn't think so. So let's talk about the phases of due diligence. And obviously, there's a bunch of factors that can change this. So this is not the end all be all term sheet of how to do it. But in the basics, we're going to go over kind of the steps of what is going to be done in due diligence. Maybe not for each side specifically, every single point, but these are the guidelines you should be expecting as a buyer and a seller and how to prepare for it. So first off is document review. Obviously, we've talked about in previous podcasts, when you talk about getting the business ready to sell, what's your multiple, financial preparation. As a seller, a buyer's going to be asking for, and especially if an SBA loan's involved, every kind of financial document you got. They're going to want P&Ls, balance sheets, tax returns, an asset list, a capital expenditure breakdown if it's especially a business that requires a lot of machinery, auto, etc. There's also going to be breakdown on the bank's also going to want documents on articles of incorporation. If you're a corporation, they're going to want information on any contracts. If you're a franchise, any franchise agreements, any other legal documents, and also corporate structure. Do you have any other contracts or policies and procedures in place for that company to operate? Those are all things you're going to have prepared. So if you don't have them, start gathering that information and having it prepared in a file so when the time comes, you can execute and deliver it. Because last thing you want in due diligence is to delay due diligence because you can't find something or because you can't produce it. And that ties back to our point about having the CPA and lawyer involved. Put them on notice it's coming because you want that CPA to be there to say, hey, if I need a P&L for the first quarter of this year, get it generated.
Yeah, absolutely. I mean, what do disorganized financials do to a deal? It's either going to stall it, or it's going to kill it completely, right? Buyers and their advisors often want financials in a very specific format also. So you need to be ready for that. I always reconcile financials to make sure that I want to get them as close to the tax returns and the P&L. If there's inconsistencies between both of those documents, large inconsistencies, go ahead and get those reconciled, or at least have a reason why that's happening.
That's correct. You're absolutely right. The P&Ls don't always match 100%, and that's not a bad thing. Very often, an accountant does corrections at the end of the year, right? So there's sometimes a few little minor changes. Often P&Ls don't have depreciation or officer salary specifically broken out. So that net number could look a little different, right? There's a couple things that can change. Everybody understands that. But the key is having it ready. Nothing's worse than it takes my accountant 3 weeks to get me a P&L. Because now you're in another financial, you go from quarter one to quarter two. If you're doing a deal, the bank is going to want as up-to-date P&L as possible. You're dragging out your transaction. As you know, time kills deals. And if something goes wrong, don't lose it over that, right? We've talked about having a bookkeeper on staff or an accountant ready. Prep them.
Yeah.
Next will be operational review, especially for bigger companies. If you're buying a larger company, say $1 million in EBITDA, you're going to have probably a couple of managers in place, probably a couple of key strategic employees. That buyer probably won't have access to them right away, as we've talked about. But now that you're in the final stages of an offer and acceptance in place, you've started due diligence and preferences too. Sometimes you do have questions before that are due diligence like before an offer and LOI is accepted, maybe to clarify a couple things for a buyer's perspective for deal structure. But let's say you have the deal complete and you're saying, hey, we've agreed to all these terms. Let's work towards going to close. You're going to have key staff involved. And if you have a controller, you probably might let them know, hey, I'm preparing to sell the business. You're going to be getting a lot of work. They're going to pick up on it too.
Yeah.
But be prepared to have those discussions with your key employees because they're going to be integral into what the buyer sees as value is buying this company. So before the buyer meets them one time, if you're far enough along, have a conversation, sit them down and say, hey, look, I've reached this point. I want you to know what's going on. This needs to stay confidential. However, here's what's moving forward. And we see that all the time. Buyers want to meet the employees well before. And what do we often say, Chris? Not to an offer and acceptance, correct?
Exactly. And a business is only going to be as strong as its systems, right? So weak SOPs, I would even say an over reliance on the owner. Those are going to be red flags for a buyer. It is
Mm-hmm.
crucial to document not only employee roles, but vendor contracts, sales processes. Make sure those are,
Mm-hmm.
very thorough and accurately documented. When you have all those things going well into the deal, it's just going to increase buyer confidence, and really make the deal go a lot smoother from the beginning.
You're right. And as an owner, be very clear what your role is. It's okay to work 20 hours, 30 hours a week, but be clear what those 30 hours a week are and think about even one-time jobs you take care of throughout the year. List that out with us when we start the process. Because nothing's worse than telling a buyer, yeah, I work 20 hours a week. And as they do diligence, find out you're working 35 hours a week. That's a big misconception. It may not seem like a lot to you because you're used to doing it, but to someone new, that workload can look a lot bigger and not be what they thought was represented to them. And that's important to be prepared for. Be honest with the transaction. That I think that's so important.
Yeah, absolutely. Got to be upfront with everything. Don't try to hide anything. It's going to come out
Mm-hmm.
eventually, even if it's after the deal, and that's going to create some friction
That's
and
even
bad
worse.
feelings. Yeah, that's absolutely even worse.
That's absolutely worse. And I would think the last part of due diligence, not one you can always control as a seller, but a buyer is going to review the market, the conditions. Heck, we talk about look at the tariffs going on today. Look at the volatility in some other markets. They're going to look at your competitors. As a buyer, you need to understand who you're competing against and who the key vendors are in the market that may be supplying both you business you want to buy and your competitors, or vice versa. If there's any proprietary information your company has, that review is so important. You need to understand who you're going to be competing with, why you're competing with them, and what they might do better than this company. And that might be an advantage you find going in as a buyer saying, hey, this company can definitely upgrade its SEO, its digital media presence. Or maybe we dominate there. How is this company doing it? I need to make sure I fully understand that before I buy this company. You're never going to know every single facet of the company like the back of your hand. But if this company has a strategic advantage in a specific field, as a buyer, dive into that. And as an owner, be prepared to share that and be prepared to work with them, because that is what drives value to your business, and it can increase, as we've talked about, your multiple.
No, I agree with you on what you said, that you can't control all these things. Some of these are
Mm-hmm.
external factors, but you got to realize external threats can kill deals, even if your internal operations are strong. Whether
Yeah.
it's competitive saturation in your marketplace or unforeseen regulatory changes. I'd say the biggest one is those poor online reviews. Get a handle
Yep.
on those before you go listing your business. If you've got terrible
Mm-hmm.
Google reviews or Yelp reviews, that's going to scare buyers. That's going to be one of the first things they look at your business when they're starting to kind of dive into your information.
Mm-hmm.
You need to be aware of your digital footprint and your market position.
It's more important than ever, and it's changing by the day too. And unfortunately, I know people say, well, I can't help a Karen, quote unquote, leaves me a bad review. You're right, you can't. But take it as a moment to look back and say what went wrong and why they did it before you go to sell. Do I, like you said, SOPs, standard operating procedures in place that can prevent this from being an issue? Did my delivery team make a mistake because we don't have enough written down? A deal we worked on, a lawn care company, how great were their field manuals, their training, the preparation, the binders, the materials? If you ever had owned that company one day in your life, you could walk in and read that material and be prepped in less than a week, right? It was all laid out. And that's what brought value to that deal.
Yep, absolutely. What
So
do you have against people named Karen, by the way?
I'm sorry. I guess it's a millennial thing. I apologize. For those who don't know, I'm 34. I guess we're a different age group, so I do apologize for anybody listening who doesn't understand who Karen is. You'll learn. Go Google it. Like digital presence. Go. You need to know if you don't know who Karen is. That's coming next. So that kind of leads us to our next part. We talked about preparing to avoid finding, red flags, common issues, uncovered during due diligence. When you talk about inconsistent financials, I think the number one problem we face when we get to the closing table is, man, how many times do we find a UCC still standing out there? If you've had a loan on a piece of equipment, get it taken care of. Am I right?
Yeah, absolutely.
Lawsuits, forgotten lawsuits, ones you thought were settled, but paperwork was never filed. Be prepared for that. As a buyer, expect the unexpected. Especially in today's society with legal happy people ready to sue anything. Understand that a lawsuit's not a bad thing. Yes, lawsuits in theory can be bad, but a lot of times there's a bunch of frivolous ones out there, and the company's just finishing it. And that's another key thing to consider, Chris. Insurance. Who's a provider of insurance for the business? Do you need to get in contact with that insurance provider and get things organized. Have an understanding what that premium might be. Is it going to be a raise in premium? You need to consider that.
Yeah. No,
I think the
absolutely.
next
I
one,
mean, yeah, go ahead.
Mhm.
Go ahead.
No, I was going to say, you go.
No, I was going to say even the smallest discrepancies, they raise big questions, right? If
Mm-hmm.
financials show monthly fluctuations, you got your insurance is not up to date, anything like that is found during due diligence. What's it create? It creates doubt in the buyer's mind. They're
Mm-hmm.
going to wonder, what else am I going to find? They're expecting to go into due diligence. Yeah, they probably are realizing they're going to find a few things, but if it's constantly going to be one thing after another, that doubt's going to set in, and eventually they may back out
Mm-hmm.
of the deal altogether.
No, you're absolutely correct. And, there's always something found in due diligence. Doesn't mean it's bad. Let's preface that. You're going to find something just because there's a lot to dig up in a company. And not always business owners know every single detail about your company. You can't have your finger on everything all the time, perfect memory. No one's going to blame you for that.
Right.
But I think one of the things most owners make the biggest misrepresentation of or misunderstanding of their business is overstating their contracts and their revenue for certain customers. And I think that leads us down a rabbit hole. I think I want you to kind of touch on a little more. Is often we set a multiple. We find the value of the cash flow. We set a multiple at the value of the business. That cash flow is as good as documents we're given on our initial. We reviewed the company, reviewed the financials. But a really good buyer is going to want to do, guess what? They're going to want a Q of E or a quality of earnings analysis.
Oh yeah.
Well, I'll let you dive in on that some more, but those are great for buyers and a great tool to protect yourself as a buyer. And we recommend you doing one for companies of certain size. However, the QV can sometimes come back and be a little confusing. And I'll let you touch a little bit more on that.
Yeah, once you get to that part of the process and a buyer's gone out and found an accounting firm that's going to do a Q of E, it's probably one they've already worked with if they've done multiple deals before. That Q of E is it's even more excruciating than an audit. Really, it's
Mm-hmm.
gonna, because an audit's gonna look at financials, tax returns, P&L, bank statements, and make sure everything lines up. This is going to be looking at revenue consistency, accrual versus cash, where transactions entered correctly. I had a whole
Mm-hmm.
list here. Revenue adjustments is a big one. I've got customer concentration, declining or inconsistent revenue trends. What
Mm-hmm.
about personal expenses run through the business? We often call those add backs, but if you overestimate it, what you're adding back or anything like that, it's going to be found
Mm-hmm.
during the Q of E. And non-recurring expenses, lawsuits,
Yes.
settlements, COVID costs, one-off consulting fees, all those are going to be recategorized if they're not categorized correctly in the first place.
Mm-hmm.
So, yeah, it's something to be aware of if you're, about to enter into a deal and you're interested in what a Q of E entails. I've got a checklist. Reach out to us. Reach out to me. I'm happy to send that to anybody and get you some information on that.
Absolutely. And I would like to add too, as a seller, don't be afraid of the Q of E. Yes, it can seem like, oh, it might change what my business might look like. It's not. Be happy the buyer is willing to spend 10, 15, 20, what, 30, $40,000 for a Q of E to really know what they're buying. That way, no one can come back and say, you didn't tell us the truth on the financials or we didn't understand. It's an important part of doing deals. And I think you hate to see your numbers, as some owners feel, chastised or you didn't enter them correctly. That's not the case. What a Q of E is saying, like you said, you mentioned an audit. An audit is it real? Yes. QV says, okay, it's real. Let's make sure it's in the perfect exact slot for it. And
Right.
that's not a bad thing. If anything, it gives a true understanding. And we talked about this earlier this week. As a seller, if you've got a pretty good sized company and you're serious about selling, yes, a Q of E could cost you 10, 15, 20 up front. But to have that Q of E done in advance to present to a buyer, you want to talk about shoot up the leaderboard of businesses that want to be bought. You will be one of the top 1%, even probably top 0.5% of business on the market if you have a QV done in advance. You would talk about get buyer confidence through the roof. That is an all-star move to make. And I know we haven't always kind of used that term a lot, but if you're listening as a seller, talk to us. We can walk you through that. You want to talk about get your business sold. That's probably the number one thing you can do up front is get that QV done.
Yeah. Yeah, I would agree with you on that.
The next thing about due diligence, we talk about uncommon mistakes too, is the life of a vehicle. Often someone says, oh yeah, that truck's got what, 100,000 miles on it. Well, come to find what's the odometer say? 120, or, oh, I changed the transmission on that car 6 months ago. Well, it was actually 3 years ago. A good buyer is going to look at the lifespan of equipment, look at the mileage on it, the value of it. As an owner, no one's going to ask you, well, correction, they may ask you, but you shouldn't be expected to give the exact blue book value of every single vehicle. That's a buyer's due diligence to review and there's companies you can hire to come in and look at the VIN numbers, run all that information. And as a buyer, if you're buying a fleet, like say a trucking company, absolutely do that. Get someone to come in third party, make sure one, everything's accounted for, right, Chris?
Yeah,
And two, make
exactly.
sure it's in good shape. We take listings before where we went out to the job site and goes, oh, I didn't realize we had that trailer over here. And that's like, man, you're looking at 20, 30, 40, 50, $100,000 in equipment and VIN numbers just laying around, probably with UCCs on them. So if we were going to close and a lawyer does a search, all of a sudden, where are these 5 UCCs sitting at? I mean, how long? I mean, banks get bought out, right? I think on one deal, didn't it take 2 weeks for a bank to track down the former owner of the UCC because it got sold out twice at some point.
Yeah.
Like, don't let that hold your transaction up.
Yeah, UCCs,
So,
they can be a drag after the deal's closed, and we're trying to wait on those to get funded.
oh, absolutely. And SBA wants to know every single piece of equipment, period. Doesn't matter.
Yeah.
They're going to, if they want it, they want it. And that kind of leads to our next topic in due diligence, how to prepare sellers. Those of you listening for due diligence, how do you prepare? One, I mentioned the QV reference a while back. Keep that in the back of your mind. I don't know how many times we're going to stress this, Chris. What is the number one thing they can do with their financials before they bring them to us?
Got to get them cleaned up.
Absolutely. Get those financials prepared. Even if you're not sure, get that accountant involved. If you don't have an accountant, please get one. And if you do have an accountant involved, get, like I mentioned earlier, getting them prepared for the sale. Tell them, hey, look, I'm thinking about selling in 6 months. I really want to work on my financials. We've had clients say, well, my accountant never told me that was a problem on financials. Well, no, their job is to put it, enter it, and submit it to you. Doesn't mean it's not time to clean them up. It doesn't mean they're wrong, but it's like time to pick up your date in your car. Would you rather have it polished and cleaned and washed or covered in pollen?
Right.
Let's make it look its best.
Yeah, let's talk about what you mean by people may not know what we mean by clean up the books, and to me that means start normalizing your ad backs, all the discretionary, we call it, that kind of expenses.
Yes.
Make sure that it's
Phones,
clear.
credit cards,
Exactly. Make
travel
sure
too, travel and expenses.
Right. Make sure there's nothing complicated, and you've got a nice financial narrative. So you hand somebody your P&L or your tax returns. If you're going to hand them what you run through the business on discretionary expenses, it makes sense. It ties to it. It's not all mixed in together. And that's what I mean when I say clean up your financials, right?
You make an excellent point. You're right. I would even say too, under your expenses and other income, if you've got maybe 10 expense categories, there's more than that. Get every single one really well identified. Break that out. Be 100% sure, because you may be surprised what you're spending where you can cut costs. Or for a buyer, especially a strategic buyer, they're going to look at any expense in economy of scale they can cut to maximize their return. And the more you can show them where they can cut those costs, the more attractive your business becomes.
Yeah.
An HVAC deal I worked on a couple of years ago, the buyer was in the business, was building another location, bought another company to merge it. He was looking at, can I cut janitorial by 60%, right? Can I cut phones by 60%? Can I cut this by 60, 40, 50, 100%? That cash flow number really grew for him and made it a much more strategic deal, and also allowed him to bid for a better price to buy that business and not bid somebody. And they got the seller a better value. So having those books well prepared, I can say cleaned up, that allows you as a broker, but also you as a seller to maximize your return. And it might not seem like a lot. And it might seem like, paying my accountant $1,000 to do that. Paid $1,000.
Yeah.
Get it done. I can't
Absolutely.
stress that enough. That $1,000 could be 10, 20, 30 on the value of your business.
Right. Yeah, because what are we trying to encourage our sellers to do? It's be transparent, right? I always say transparency is better than perfection. I often encourage my clients to disclose any blemishes up front. It's so much better to control the narrative than let the buyer discover those issues on their own. It builds that credibility and trust that we talk about. But also, if you let them know up front, you're letting them know with the asking price, the valuation that you put on the business, that this comes with it. We're already aware of this. You don't need to find this and start beating up our valuation and offer a lower asking price.
I would agree. And I would even add to that too. A lot of business owners use QuickBooks, right? Man, dive into your QuickBooks, get it more organized. So when the buyer comes in, the buyer can then transition quicker. It allows you to transition out of the business faster, because if QuickBooks is so more meticulously detailed, when they walk in that day, they can say, hey, I see where every single penny's gone. But if they see these big blank categories of, untitled expense or ask my accountant.
Oh, that's a good one.
Yeah, I know, right? How many times have we seen that one before?
I love that one.
Because they may not want to use your accountant. And then, especially if you're doing a stock sale. Let's talk about that, Chris. If you're doing a stock sale and a buyer is buying the stock of the company, they're inheriting that liability. Doesn't matter if you sign a hold harmless indemnity agreement as a seller saying, look, you can't come back after me. If you knowingly made those books fraudulent and there's not detailed records and the IRS shows up, yikes.
Yeah.
Just
Yeah.
we've seen
Fraud.
that happen. That's not a good way to do business. It's
Yeah.
not.
Yeah. Fraud doesn't care what you signed or what document the buyer signed.
That's
It's
right.
fraud is fraud, and that's still a rough situation to be in.
So getting away from fraud, let's talk about the role that us as brokers play in due diligence. Often clients, let's be upfront, say, hey, I want you to do my due diligence for me. I don't do that. I can't do that. That would be a conflict of interest. Let's be honest. If I'm taking P&Ls and modifying them and handing them to you, that's that's not what we can do. And honestly, we're not accountants. We're not CPAs. We shouldn't be doing that. That being said, what do we do? One, we have a pretty good internal checklist of what are things to look out for. Our experience in knowing what to prepare for, and I think is most strategic for you as a buyer, is if you're going to go SBA route, we already know how to prep the seller to get there. We're going to, as the sellers, we're going to prep you on what documents to get already lined up. Good brokers at the start of a listing get all that documentation in place, organized, prepared, and can anticipate what the banks are going to want. So when the deal starts, we can cut weeks and months off a transaction, which saves both buyer and seller money. We want to identify red flags like we talked about, things that we see in accounting that, hey, this looks a little funky. Why is this expense here? This seems like a really high expense. What's going on? Is this an add back? Is it not an add back? Those are all things that we do in helping screen a listing to go to market. So by doing that, you as a buyer come contact us. We've done our quote unquote due diligence, right, Chris? We've done our initial analysis and can provide that to you in the SIM. That being said, we're not auditing the books. No, I'm not going to use a medical reference like I've been using the last couple of times because you don't like it, but that's not our role. And also, it's not logical at the start of the process, which to sellers, that QV I talked about, this is when it comes into play the most. I'll let you add a couple of thoughts on, broker due diligence. I know you've got a checklist and some good things you want to mention as well.
Yeah, no, I think of myself as an advisor during the situation, during the deal, but also a translator, because there's a lot of terms we're throwing out.
That's a great way to say it.
Yeah. As a broker, it's my job to ensure that both parties understand each other's expectations, the financial language that we're talking about, and even emotional concerns, right? That plays a big part in these deals. So bridging those gaps and prevents any misunderstandings or delays, helps kind of move the deal forward. And that's what I consider my role when I'm working with buyers and sellers together to get the deal to the closing table.
Absolutely. And I'd like to add too, part of our role in due diligence is often there is going to be financial questions. Making sure that's in writing, recorded, because how often does a seller, I think this is what it was. Well, let's make sure we get it in writing, get it over to the buyer so everybody knows what that term was agreed to, because nothing's worse than somebody says they thought they said this, you said that, and then it comes down to the end with the bank, and we never got actual in writing clarification, can't close. Well, I don't remember I saying that. Well, you know how that spirals, and no one's trying to cheat anybody. It's good for us, and our role primarily too is to make sure everything's communicated appropriately. You said translating is a great way to say it. We're not experts in accounting, but we've seen so many different types the way books are done, transactions are structured, that we can help guide people through the process, both buyer and seller, to understand what they're being asked for. Very often we're asked to help find out a working capital peg or capital expenditure expense through seasonality or non-seasonal businesses. That's part of our due diligence with the seller early on to get the business prep, but also as a buyer to help you understand why deals are structured that way. And that's such an important skill set when you work with a good broker to have. So,
yeah, absolutely.
I think we've covered most of the good stuff. Obviously, we could go into specifics for every business. That's not the point of today's podcast, nor I think we have enough time for those of you listening to go through another 10 hours of due diligence questions.
Right.
But what I would say is don't be afraid of due diligence, a buyer or a seller. It's going to be your best friend because it's going to create stability in the deal. Yes, there may be some bumpy roads to get there, but it's going to solidify your deal and help you get where you want to go, both as buyer and as seller. We gave you some great points on our checklist, documents to get ready for, things to expect, things to not expect, but you may still deal with anyway. But if you do have questions, you can always contact myself, Brandon Bourgeois, Chris Sater. We'll have the link below in the comments to our office, our phone numbers, our emails. We're here to help. We'd love you to contact us before. Nothing's better than us preparing a seller and a buyer before the time comes to execute on a deal. Chris, do you have any final words you want to add?
Just preparation equals confidence. So you can confidently go into a deal. If you've done all the work, start preparing 6 to 12 months in advance, and start that process. Have a little mock due diligence on yourself, and that way
Mm-hmm.
it'll shows you what you need to clean up, what you need to be ready for. Reach out to us. We're happy to help you through that process, even well before you're ready to list the business. But yeah, start well in advance.
Absolutely. And as a buyer, your due diligence isn't always just financials. Know what you want to purchase. Do some homework. Look at different industries. Look at multiples. Look at cost. Understand what that's going to take for you to get into that business. When it comes to licensing and other issues, don't just assume you can just buy any business just because. There may be licensing requirements or maybe educational differences for daycares, for example. Can you be a director or not? Do some of your own homework. So when you walk in that room with the seller, you're educated on what that business takes to be successful and what it takes to get into it. That's going to speed up your time and relationships with that seller as well. And on that note, this is the Steps to Sold podcast. We appreciate all of you listening, both buyers, sellers, and those in between. Feel free to comment below and give us any questions, concerns, thoughts. We'd love to hear from you and share with you. On that note, you enjoyed the Masters this weekend, and I hope my bet's cash. How about you, Chris?
Yeah, exactly. I got money on Scheffler.
All right, I got Rory, so we'll see who gets paid out.
There you go.
Everybody, y'all have a good one. We'll see you next week.
Bye bye.